Afternoon or morning, depending on where you are, and thanks for being here. My name is John Queenan. I'm with Specialty Volt, and I'm also an NFDA board member. So it's good to have everybody together today. I'd like to welcome everyone to the ITR Economic Update moving forward. You know, I think after this past year, I know I'm ready to move forward. I'm also ready to leave my house, but that's probably a different story. For those of you who are with us during Tim's great talk on leadership this morning, this won't be news to you, but during the presentation, everyone is going to be muted. With that being said, we've budgeted a good amount of time for questions and answers. So please utilize the button at the bottom for Q&A. We'll be compiling them and I'll be reading them on your behalf. I'd like to introduce Alex Chausovsky. I'd like to introduce to you our speaker, Alex Chausovsky. I struggle with the last name, Alex. Did I get it right?
You got it. Nailed it, John.
Excellent. Alex is an accomplished speaker and serves as a senior business advisor at ITR Economics, a highly experienced market researcher and analyst. He has more than a decade of experience in subjects that include macroeconomics, industrial manufacturing, automation, and advanced technology trends. Welcome, Alex. Thanks for being with us today.
My pleasure, John. Thanks for that great introduction. And I want to say thank you to all of you for taking time out of your busy schedules to join us today for this great opportunity to learn, to stay aware of the developments in the economic landscape and in the vertical markets that you serve. I think the goal of my presentation is to connect the dots for you between what we see going on in the various aspects of the economic landscape and what it means to you and your business. In addition to doing these presentations, I actually work with companies on a one-on-one basis. And so I want to make sure that I provide you with actionable and practical advice based on the terrific economic data that we have at our disposal here at ITR Economics, so that you can be a data-driven decision maker. I think that's so critical at this juncture as you look towards a better year in 2021 and more growth in both 22 and 23. You need to be making your decisions based on practical, good quality data, hard evidence, rather than your gut feeling. And that's exactly what this webinar is designed to deliver for you. So I want to say welcome. We got a lot to cover over the course of the presentation for the next hour or so. But I also want to make sure that I get to the topics that are important to you. So certainly feel free to put those questions into the chat box throughout the webinar. I'll make sure that I get to them at the end of the presentation. As you can see, I've decided to title the session today Moving Forward. I think it's very accurate. Not only are we now out of the dreaded 2020 calendar year, but we are all looking forward to some better things to come. And certainly I wanted to start by talking about the elephant in the room, if you will, talk about the pandemic itself, the effect that it's having, and really focus on what we've been tracking at ITR this entire time, which is that we are continuing to see the reopening of the economy. We're very encouraged by that. There are fairly limited restrictions on businesses at this point. Of course, if you're in the restaurant space, if you're in leisure and hospitality and some of the more consumer-facing industries, you're obviously seeing a little bit more hesitancy to open up there. But as we saw just yesterday, the state of Texas is fully open for business. Now, whether you agree or disagree with that assertion, it's something that is going to be conducive, at least from an economic perspective, to getting things rolling and to building on the green shoots of recovery that we saw over the second half of 2020 and into early 2021, and really capitalize on that and build more momentum as we traverse the rest of this year to really get some good growth by the end of 2021 and carry that momentum forward into 2022 as well. But it's all going to depend, obviously, on how the rest of this pandemic unfolds. What we're seeing on the ground when we look at the actual data is very, very encouraging. And most importantly, right now, what we're paying attention to are the vaccinations. So this is the latest information, hot off the presses. As you can see, essentially over 100 million doses as of this morning have been now delivered. You can see this is as of yesterday, 96 million doses. About 77 million have been actually administered. So 50 million of your fellow Americans aged 18 and up are now have now had at least one dose of the vaccine. Another 25 million have had both doses. And you can see we're starting to make some inroads in terms of getting vaccinations to a majority of the population. And what's really encouraging in this area is the pace has continued to rise over time. If you look at last week, for example, we're averaging about 1.7 million vaccinations given around the country. That's per day. Over the weekend, we actually hit record levels. 2.4 million people got vaccinated both Saturday and again on Sunday. And so you can see it's really ramping up. And then, of course, we had the best news so far, which is that the FDA gave emergency use authorization to the Johnson & Johnson vaccine, which is really, as a consensus opinion in the medical community, a game changer in this environment because it is very different than the Pfizer and Moderna vaccines that we've been using so far. It's different in two ways. Number one, the storage requirements are much simpler. You don't have to have the deep freeze that the Pfizer vaccine requires, or the more colder area storage than typical vaccinations for the Moderna vaccine. This Johnson & Johnson vaccine is something that every doctor's office can administer. They've got the facilities to store it properly. CVS, Walgreens, it's coming to the local pharmacy around the corner from your office and your place of living. So that's very encouraging. The second component is that Johnson & Johnson's vaccine is a one and done vaccine. It does not require 2 doses the way that Pfizer and Moderna's vaccines require. So again, we are expecting good things from this. They committed to delivering 4 million doses right off the bat and reassured us that we will have 100 million doses of the Johnson & Johnson vaccine available by the end of June. So when you take these numbers, the pace of vaccinations right now and what's coming down the line, the consensus opinion, and certainly President Biden acknowledged this yesterday when he said that the vast majority of Americans should be able to get on-demand access to vaccines by May or June at the latest. That's as of yesterday. So we can really start to see the light at the end of the tunnel for this pandemic. And we believe that that bodes extremely well for the economic recovery to continue gaining steam and really building that momentum, particularly as we head into the second half of the year. So that's the good news. We see those green shoots really developing to something more meaningful. We have had a very long-standing position that the first quarter of this year was the low point in the business cycle, and then we had accelerating rise starting in Q2 onwards through Q3 and Q4 and into 2022 as well. At the same time, we've got developments in the political arena that I wanted to highlight for you. So we saw that very clearly the stimulus actions that were taken by the Trump administration last year and have been continued to be taken by the Biden administration so far have been the difference maker in a faster recovery in the US, where you compare us to places like Europe, for example, or South America. And the reason for that is it has provided a bridge of liquidity in terms of cash, both for individuals and for businesses. The $1,200 checks that went out in April, the additional unemployment benefits, the PPP funding, all of that has been really, really important in kickstarting the US economic recovery mid-2020 and onward through the last half of 2020. And as we look towards the impact of the second stimulus bill, we now have continued evidence that I'll share with you momentarily that that is also going a long way in helping us maintain this momentum and continue on the upward trajectory as we head into 2021. We have a Congress and White House that is aligned, which is, in some people's opinion, a good thing, in others, not such a good thing. I know that the business community is very concerned about the potential for some of the more extreme plans of the Democratic contingent to come into fruition, things like higher taxes, things like the Green New Deal, which will come with a lot of regulations that are focused on environmental protection. But what we see at ITR Economics is there's absolutely no guarantee that any of that is going to take place this year. And we actually think that we're kind of in a Goldilocks zone, because with the razor thin majority that the Democrats hold in the Senate, some of the more conservative, more business-friendly Democratic representatives and congressmen are likely not going to vote in favor for some of these more extreme measures. So we have a very positive situation where the government is clearly behind supporting the economy and getting us back onto firm, solid footing in response to the pandemic, but not likely to undertake or propose some of the more egregious proposals that they have been discussing, in the run-up to the 2020 election, for example. So we're very encouraged by what we're seeing in that area. We also recognize that it comes at a cost. The stimulus that we've passed, you can see, has resulted in a more than $3 trillion deficit on the part of the federal government in 2020. And many people are very concerned about what that means from an inflationary perspective, and more importantly, from a long-term implications to our economic stability and prosperity. And what I can tell you is that ITR has had a long-standing view that, yes, we are living beyond our means as a country. We are heading for the 2030s Great Depression. Some of you are probably familiar with that term. We've been talking about this for the last 7 years since Alan and Brian Beyo wrote the book Prosperity in the Age of Decline, where they've really outlined that the combination of growing national debt and demographic change is going to create a very difficult environment for our economy in the 2030s. And what I'm happy to report to you is we still, given everything that happened in 2020 and is happening right now, we still remain committed to that timeline. We have not moved that Great Depression outlook forward into the 2020s. We think that in the near term, we are benefiting from very, very low interest rates. And you can see the impact of that on this slide here, in the sense that the red line here shows you the bond yields. This is the 10-year treasuries and the interest rate payments as a 3-month moving average on those. And the blue line at the top is the amount of money that the US federal government spends on the interest rate component of the national debt. So we're in no business of paying back the actual principal of that debt, but we do make regular interest payments. And as you can see, because of the decline in interest rates, even despite the recent rise, the decline in interest rates that we've seen since pre-pandemic levels has actually resulted in a pullback in the amount of money that the US government is spending on those interest payments right now. Because we've seen a commitment from the Fed to this low interest rate environment, we think that in the near term, that's going to be very beneficial and not going to place a great deal of strain on the federal government as it pertains to the national debt. So where their focus is going to be is to make sure that we've got the liquidity and the support that we need to get back onto that solid financial footing and to get back into growth territory after the very difficult year that we had in 2020 as a result of the pandemic. Now, longer term, we're going to be looking for warning signs, things like substantially higher rates of inflation in the second half of this decade. But even at that point, I think you have to think about where does the US stand relative to some of the other governments around the world. Happy to report that even despite the rising national debt, we still are the best looking dog in the pound when it comes to other people being willing to not donate, but lend the US government money. Our interest rates are much more attractive than many other safe haven assets around the world. If you look at Eurozone bonds, for example, or Japanese bonds, our rate of return and the interest that investors, both institutional and individual, both foreign and domestic, can make by lending the US government money outstrips what they make by lending money to these other foreign governments. So that is why we believe that the US is going to be in a favorable position, and it's going to be able to continue the deficit spending that we've been doing so far. So still very much looking towards the 2030s as a difficult time frame, which means that the 2020s are actually going to be a great opportunity for you, both as business owners and decision makers and as individuals, to grow your wealth. And that's what I really want to focus on as part of this conversation. So when you look at all of these developments, the COVID-19 pandemic and the latest vaccination data, the decisions by the government, it's very easy to get all excited and let your emotions really kind of rise and get you worked up. But at the end of the day, when you want to be a data-driven decision maker, what you have to do is you have to ask yourself, are these just near-term events that are designed to get me all riled up, or are they part of the fundamental economic landscape that is actually going to affect the performance of my business on the ground? And I think when I look at both COVID and the political stuff, right now, I would put them in the category of near-term events, because the fundamental economics are actually very, very different and very encouraging when you look at the evidence. So let's take a look at some of that evidence. The first piece of evidence that I want to show you is actually the outcome of some of that government intervention that I've been talking about. And here on this chart, what you can see is US disposable personal income. What that represents, essentially, ladies and gentlemen, is the amount of money that the US consuming public has left over after they cover their obligations, their debts, every single month. So you can see that prior to the pandemic here, going all the way up to April of 2020, the rough average for disposable personal income was about $15 trillion in the United States. Then here comes April 2020, here comes that first stimulus package, and you can see how significant of a bounce upward we experienced as a result of that stimulus, north of $17 trillion. Over the subsequent 8 months, you can see that money did pull back, but it never actually went below the pre-recession levels. And with now January's data available, we can see that the impact of the December's second stimulus package has been equally beneficial in bumping that disposable personal income up in a positive directions. What does all this mean? The so what of this from your perspective is twofold. Number one, this is showing you really how atypical, how uncharacteristic this particular recession and downturn are relative to what normally happens in the US economy. If you think about typical recessions that are accompanied by the kind of job losses that we suffered, you have a situation where disposable personal income goes down significantly. Not so this time around. It's not only elevated, but it's substantially ahead of where we were pre-pandemic. The second component here, and probably the more important one from a practical applicability perspective, is that the US consumer remains in a very strong financial position. That means they have both the willingness and the ability, more importantly, to go out and spend money. Now, we are still somewhat constrained in how we can spend that money. So most of us are buying goods rather than services and experiences, which in terms of your industry is actually quite a favorable development. The more goods that are bought, the more fasteners are likely needed to pull those goods together or to be used as components. And that's actually painting a very favorable outlook for your sector in 2021. So when we look at the impact of that stability of the consumer, that really bodes well to the overall macro environment. And when I say macro, I'm talking about US gross domestic product, or GDP. This is essentially the catch-all of economic activity. But the key factor here is that 2/3 of our GDP is personal consumption expenditures, basically reflective of consumer demand and consumer spending. And as you can see here, we have a very favorable outlook. So let me break this down for you just a second. Each one of these bars represents a quarterly GDP value. And what you'll see here, this is Q2 of 2020. That means that when we shut down the economy back in March and April and early May of last year, we essentially self-imposed the recession upon ourselves. We wiped out almost 5 years of economic activity in one fell swoop when we shut down the economy. Now, as we moved to reopen, slowly but surely and hopefully safely, you can see immediately we had a bounce back in Q3 and onward and upward growth in Q4. And when you look towards our forecast, which is represented by these teal bars here, that's exactly what we're calling for, is more increases, more expansion over the next 12 quarters, all the way out through the end of 2023. So when you think about the implications of this outlook to your business, what it means is it's relatively smooth sailing ahead. And you need to be asking yourselves, how can I take advantage of the low point in the business cycle that I'm going through right now to make sure that I'm positioned correctly to capitalize, to take full advantage of the next 3 years of growth that are likely ahead of me? What kind of people do I need to have in place? What kind of equipment and capacity do I need to have in place? Is this an opportunity for me to invest, whether it's in my products, in efficiencies and productivity, things like automation, and certainly potentially acquisitions and looking at real estate strategies to take advantage of other people's pessimism right now before we get onward into the next 3 years, which are going to be reflective of expansion in the US economy consistently, and hopefully very welcome news for you as a business. So this is really, really a positive outlook. And a part of this positivity, I think, has to be connected to the interest rate environment. So this particular slide shows you basically the position of the FOMC, or the Federal Open Market Committee. This is the group of regional Fed chair presidents that get together once a quarter, and they have conference calls more frequently than that, but they have a quarterly meeting where they say, here is our expectations of where interest rates, the federal fund rate, to be specific, is going to be at the end of each one of these calendar years. So each red dot here represents a regional Fed chair president and their opinion of where 2021, 22, and 23 and onward are going to be in terms of interest rates. And what you can see here is that they clearly have a consensus opinion that at least through 2022, they're going to keep interest rates at today's historically low levels. Now, there's a little bit more evidence that some of them are thinking about raising rates in 23, but even there, the majority of people think low interest rates are going to be around for the next 3 years at least, before the longer term outlook goes several percentage points higher. So the implications of this to you are, have you considered using other people's money to invest for the future growth of your business? What I mean by that is access to capital right now is abundant. Low interest rates mean it's very attractive to use somebody else's money, a bank's, some other investors' money to really position yourself for that future growth. And there are multiple areas that you can think about. There are some distressed assets that are out there that make for potentially valuable acquisitions to grow yourself inorganically. But certainly everyone that's in attendance today should be thinking about, how do I invest in my products? And do I have the right mix and the right portfolio to serve the ever-changing needs of my customer base? You can certainly look at investing in your processes, basically cross-training your people, looking for those productivity and efficiency gains through automation whenever possible. This is the time to invest. It's one of the big hot topics that I talk about with individual companies one-on-one right now. I asked them, if you were to look back at 2008, 2009, specifically at the low point during that Great Recession, and ask yourself, what should I have done more of? Should I have hired those people? Should I have bought that piece of equipment or machinery? Should I have pulled the trigger on that acquisition or bought that warehouse instead of leasing it? These are the kind of things that I want you to ask yourself, because the opportunity for investment is so much more fruitful at the bottom of the business cycle, where we are right now, rather than at the top, which is where we were in late 2018 and where we're likely to be again by the end of 2021, early 2022 timeframe. So if you're going to do something, if you're going to be aggressive and think about how to position your business for that future growth, now is the time to act. So shifting a little bit more to what we see in the economic fundamentals landscape, I'm happy to report that our methodology that essentially has allowed us to forecast all of the things going on with the economy consistently and accurately over time has held up beautifully over the course of the pandemic. And one of the key components of our methodology is looking at something we call leading economic indicators. This, put very simply, are basic economic series that have the ability to predict what other economic series are likely to do. So what I want to show you first here is our dashboard of the top dozen so leading indicators and where it stood back in June of 2020, the last time you likely heard from ITR economics. So you can see here, at the time, the majority of the leading indicators were in decline, and that was certainly not painting a very favorable picture of the immediate future, which certainly was confirmed by the decline in GDP in the second quarter and downward trends over the next several months. Now, the good news here is that when we look at the same dashboard of leading indicators now, they are all consistently in rising trends, which is music to all of our ears here as economists, especially because these are such diverse group of leading indicators. You have everything from exports to the rest of the world, to industry capacity utilization, to housing, to the stock market, to the purchasing managers index. And all of these indices, all of these leading indicators are pointing to rise not only for the immediate future, but as you can see here near the top, these have lead times upwards of a year, or in some cases even more. So they're saying positive movement in the US business cycle through the next 3 or 4 quarters, essentially not only through the end of 2021, but onwards into early 2022 as well. So I hope that this is the nudge that you need to start being more aggressive. Pursue market share gains, expand your footprint, lead with optimism. Your people are looking forward for you to doing that. And certainly we have the corroborating data and the evidence to support that that is the prudent, the justified course of action as we move into the future. I talked about GDP earlier, and I mentioned the fact that GDP, in large part, it's not only reflective of consumer behavior. It does have some components of business investment and certainly of government spending. But when I zero in on the economic landscape component that much better reflects fastener distributors and the prospects for your world, what you're experiencing on the ground right now, it's actually not GDP, but rather a series we call the US Industrial Production Index. This particular series is our benchmark for business to business and manufacturing and industrial activity in the US overall. The manufacturing represents about 75% of this index, with the other two components being heavy industries like mining and oil and gas, but also things like utilities and automotive and all of the sectors that fasteners get used in quite a bit. And I want you to understand that the industrial economy had a very different experience over the course of 2020 than what we felt in the GDP side. So let me break this down for you step by step. On the bottom, you're seeing the data for the US Industrial Production Index, but plotted as a 12-month and 3-month moving average. So this essentially represents the volume of industrial activity that happened over the last 12 months. And you can see this green line has certainly pulled back quite a bit. Now, on top, these two lines are reflective of the same exact data series, but we're not talking about the volume of activity, rather the rates of change of that activity. So the green line here is the 12-12. That is what we know as the year-over-year growth rate plotted over time. The 3-12 is the quarter-over-quarter, the shorter-term rate of change. So let me point out a few key differences here. First, notice that through the end of 2020, the industrial economy was down about 7%. Now, GDP did not contract by 7%. That was closer to 2.5%. So basically, the industrial economy felt the contraction much more acutely and severely than what the consumer slice of the economy felt. But the good news is that we have seen a very clear turning around. So the 3-12 here, you can see bottomed out back in June of last year at the low point in Q2 and has now upward passed this year-over-year rate of change, which is what we at ITR called checking points. We look for 3 key checking points. Number 1 is the low in the 3-12, which we have. Number 2 is the upward passing of the 12-12 by the 3-12, which we also have. And the third and final checking point that we look for to confirm that there is a business cycle low in the industrial economy is when this 12-12 line bottoms out and starts heading in an upward direction. We think that happens in March. So we are essentially going through a business cycle low in the industrial economy right now. This is the best time to invest for future growth at the low point in the cycle. Not only are you likely to see more favorable prices, but it also gives you time during that ramp up period to be prepared and fully get those new assets up in place and running so that they can all be available to make you money as we get into phase B, which is the best part of the cycle when the growth rates are positive and accelerating over time. So I hope that you take this advice and do look to the future with more optimism. Take that more aggressive stance. Look towards your sales and marketing organizations. They're going to be the things that separate you from your competitors. Hire those talented salespeople if they're available to you. Look to be proactive in terms of gaining market share and really outperforming your competition. That's how you get ahead as we're coming out of this business cycle low. And I think that the comments that I just made about hiring people are very key because there are some very unique opportunities that are going to be available to you as we come out of this recession. And the majority of these opportunities, I believe, have to do with the fact that the pandemic built upon some trends that went on in 18 and 19 related to the trade wars, in the sense that we have a very real recognition that outsourcing is not as powerful as it used to be. And many businesses are actually looking to near source and reshore some of their operations. Why are they doing that? Very simple. According to the data from the Reshoring Institute, they did a survey here and they asked, what are the biggest things that businesses experience when they try to source from overseas? And as you can see here, it's delays in shipping, production schedule delays, probably related to not being able to get components and parts, and the inconsistency in quality. So business leaders and decision makers are increasingly recognizing that it is no longer prudent to just focus on the cheapest source of production. We have to make sure that we have product availability. We have to make sure that there's resiliency in our supply chains. We have to make sure that we've got quick turnarounds in terms of being able to get product to our customers. And that's exactly why we're so bullish on the future of US manufacturing. Because when you think about, for example, the resiliency of supply chains, it's actually quite favorable here in the US relative to some of the traditional outsourcing powerhouses, countries like China, Mexico, Vietnam. So if you look at this data from the FM Global Resiliency Index, it shows that the United States in 2020, so very current information, had a supply chain risk value on this index of 85.2. Now, keep in mind, the higher the value, the less risk there is to produce in that particular country. Now, if you look at some of these more traditional outsourcing locations, look at where China is, 61.8. If you look at Mexico, 50.5, Vietnam, 49.1. So as you can see, the US has proven itself to be substantially more resilient from a supply chain risk than what we see in these traditional outsourcing countries. And so as a result, more and more decision makers and business owners and investors are saying, we want to be in the United States. We want to do business here in the country, or at least near to the United States. And that's going to create fantastic opportunities for you, because we think that it means more opportunities both with your existing clients as they expand their local footprint, and some opportunities with potential new clients as they try to open up facilities here in the United States. But you cannot just wait idly by and expect those opportunities to come knocking on your front door. You've got to be out there hunting for them. That includes the need for some additional salespeople. I have several clients that recently hired, 4 to 6 people as an internal sales team, specifically to seek out, identify, and then pursue the opportunities related to these near sourcing trends. And I can tell you, some of them are actually having some substantial success in this area. But again, you cannot sit back on your laurels and wait for that business to come to you. You've got to be out there looking for that business. Now, the second element of this trend is the cost component. And obviously, costs still remain very high in terms of priority, but many people misrepresent how expensive it is to produce things in the United States relative to some of these traditional outsourcing countries. And to back this up with good quality data, I'm showing you the manufacturing cost index from the Boston Consulting Group. Now, this is based on 2019 data, and I want you to see they gave the US a manufacturing index value of 100 here, so that they're comparing other countries from around the world to what the cost of manufacturing is in the US. Now, you'll notice here that European countries like Germany, France, Italy, the UK, and so on, clearly much more expensive than the United States. But what really stuck out to me as a big surprise was the fact that China here is actually only about 3 to 5% cheaper to manufacture in than the United States. The traditional adage is that it's substantially cheaper to manufacture in China, but this does not reflect the reality that they've had wage increases and energy cost increases of double digits consistently for the last several decades. You look, this is counting labor, electricity, natural gas, and other energy costs, and it doesn't even factor the cost of logistics and shipping into this analysis. So when you add in those additional costs of shipping things by boat or by air freight, then you're talking about a very advantageous position for the US relative to China. And the other two places are not much better off. Vietnam here, you can see 94. That means 6% cheaper than the US manufacturing cost basis. Mexico at 86%. That is clearly quite a bit cheaper, but you have to take this in context with the supply chain risk that I showed you on the previous slide. So this is one of the main reasons why we believe that as we look to the future, the US manufacturing sector has a very nice trajectory over the course of the 2020s and will present you with a lot of opportunities to grow your business. But like I said, don't wait for those opportunities to come to you. Be out there proactively identifying them and seeking them out so that you can take advantage of them. As you do so, I also want to remind you that despite these horrific unemployment numbers that you're constantly hearing about, the challenge for you will be attraction and retention of your top performers. So this data on the slide shows the unemployment rate as it stands today. I want you to see how different this time around really is compared to the, let's say, 08-09 period, or even the 2000-2001 recession. During those times, it took about 3 years for the peak unemployment rate to come down the way that it has done so this time around in about 6 months. And yes, of course, there are still about 4 to 5 million additional people in the ranks of the unemployed right now, but those people are primarily from the retail environment, leisure and hospitality, and certainly the restaurant and the food service space. They are not manufacturing, they are not distribution, and they're not construction employees. So as you look towards the future, recognize talent has got to be a priority for you, and you've got to be very strategic in how you approach talent acquisition and retention, because it could be a very limiting factor for you as you get busier over the course of 2021 and into 2022. And you've got to make sure that you don't encounter the same kind of bottlenecks, the same kind of limitations in terms of your capacity, because you don't have the right people in place. So make sure that you keep paying attention to that. The last thing that I wanted to mention for you that's kind of macroeconomic in nature, but I think it's probably one of the most important things that I want you to take away from the webinar, is that you have to be extremely on top of your pricing game. What I mean by that is we have significant movement in the price of basic inputs, commodities. So you can see here, this is the 3/12 rate of change, or the quarter over quarter growth rate. That means comparing the prices of copper for the last 3 months to the same 3 months from a year ago. Copper is up over almost 42%. If you look at the monthly rate, copper is up almost 60% over the last 6 months. And the same can be said to different extent for zinc, for aluminum, for steel, many of the basic inputs that fasteners use and really are leveraged in the manufacturing domain in general. In addition to this, you've got wage pressures based on what I was telling you about the market. And of course, shipping and logistics costs are rising significantly right now too. So I know that many of you coming out of the hole that you found yourself in back in 2020 are going to be focused on getting your top line back to pre-pandemic levels as quickly as possible. But please do not lose sight of the fact that in addition to the top line, you're not in business to grow revenue. You're in business to make a profit. And so you have to have a comprehensive and a proactive strategy in terms of being able to protect your margins as you see increasing prices all around you. One of the great strategies I recently discussed with a customer is that typically they produce their quotes, and those quotes are valid for 30 days. But in this environment of very quickly rising prices, this particular company has decided to decrease the validity of their quotes to their customers to just 10 days to make sure that they don't experience any kind of shock from a profitability perspective. And I thought that was a brilliant maneuver on their part. But in general, you've got to assess your products at the product line basis. You've got to assess each of your customers and ask yourself, am I where I need to be with this customer or this product from a profitability perspective? If I'm not, then sometimes you got to make those tough calls and walk away from those clients. Keep in mind, the vast majority of your profit comes from a creme de la creme, the top echelon of your client base. So you have to be very judicious, very smart about how you go after this, and don't just chase every top line revenue dollar. You have to ask, what does this mean to the contribution to my profitability? And if it doesn't contribute, then you have to be selective and strategic in terms of, making sure you pick the right customers to do business with. But overall, I think this represents one of the greatest risks to your performance in 2021. Don't just focus on top line. Make sure that you're protecting your bottom line as well. All right, so that's, I think, a good overview of the kind of big picture view of the big macro landscape. I think the next thing that I want to cover with you is a little bit more zeroed in look on what to expect from some of the key vertical markets into which NFDA member companies typically sell. So let's start in terms of automotive. This is showing you North America light vehicle production. So Just as a reminder, we're going to look at a bunch of charts that look similar, and I want to make sure that you understand exactly what I'm presenting. So in this particular case, we're looking at millions of units of automotive production. This is light vehicle particularly, and you can see here at the bottom, this basically says 12.7 million light vehicles produced over the last 12 months. Year over year, that's down 21%, but the quarterly growth rate now has come up and is above the 1212. So that means that we expect this green line to rise over the course of the next 1 to 2 quarters. That's the lead time between the quarterly number and the annual number. So basically, this is in a positive momentum. There is going to be more rise ahead for automotive, but right now, unfortunately, automotive is particularly pained by supply chain issues, especially focused on semiconductor availability. We think that that is mostly a near-term problem. It likely gets resolved by the end of the second quarter, and then we have some more upside momentum over the course of the second half of the year. So we are looking with optimism at the prospects for North America light vehicle production and automotive sector performance overall. Now, heavy duty trucks have shown less reliance on those semiconductors, and you can see here it's a more positive interpretation. So here the 312 is clearly made a very big gap between where it is right now. Even though it has ticked back down in the latest month of data, it's still, you can see 27 percentage points of difference between the 312 and the 1212. That means pretty significant upside momentum is coming to the business cycle for heavy duty truck. And we do expect that by the end of the year, we get back out into positive territory. So that upside momentum is going to persist really despite this recent pullback in activity. So looking at automotive sector overall, much better prospects relative to what we saw in 2020. If we look at some of the off-highway sectors, agriculture, construction, mining machinery, you can see that this is in recovery as well. The green line is already rising here. The 312 has achieved all 3 checking points. The low point back in early 2020, the upward passing, and today is almost back in positive territory already. That bodes extremely well for the particularly, I think, the construction and mining sectors, construction being driven primarily by single family housing, which is on fire right now, mining really being bolstered by the increase in those commodity prices and increasing demand for those commodities. And certainly we're starting to see some of the similar dynamics to what I just described in the agriculture sector as well. So this is one of the more positive sectors when you look at, machinery that moves when you compare it to heavy truck or light vehicles. We think this is clearly showing some of the more bright signs of recovery relative to those other sectors. If you look at the marine space, the shipbuilding and repair production index is not nearly as positive, but we are seeing at least 2 of those checking points. So the low point here, as you can see, is clearly in. Now, it's been quite a volatile mixture here, and the 312 just now, only on the last month of data, has upward past that 1212. So a bit of a longer road to recovery. We're probably looking at either late this year or most likely in early 2022 when we get into growth territory for shipbuilding and repair as you look at it in this particular data series. But the positive checking points are certainly encouraging. If you look at heavy industry, particularly the process sectors, power generation, chemicals, oil and gas, they tend to use a lot of these devices like turbines, generators, electric motors are included in this data series, other power generation equipment. And here you can see a very, very positive development indeed. The 312 is already up 11.6%. So the last 3 months compared to the same 3 months from a year ago are up double digits. That's very, very encouraging news. This 1212 rate of change is going to rise substantially over the next 2 quarters, and you're likely going to see positive developments in the sector by mid-2021. So a lot of opportunities in that rotating machinery sector if you're selling into that category. For overall OEM performance, we are expecting very solid growth. You can see here similar dynamics to what I expected, what I explained in the rotating machine space, but this includes everything from machine tools to packaging to material handling to woodworking to paper and paperboard, food and beverage, and everything that's really captured in that OEM space. 9.6% growth over the last 3 months compared to the year ago level. We see this green line already starting to move up in a positive direction. You can expect that this particular series is going to be a very good growth year. A lot of companies are looking to make investment in terms of discounted equipment and machinery. And so this is going to be a big demand side pull for the fastener distributor industry over the course of 2021. That's my and my colleagues' opinion here at ITR Economics. The consumer sectors are ahead of the industrial space, no doubt about it. You can see this is household appliance production. I know many of you sell into this category. It's already up 3.1% year over year. You can see the growth rate on the 112 basis. That's month over month, double-digit territory, with the latest month of data up 16.5% relative to the same period from a year ago. We expect this momentum to continue onward through 2021. So this is a really good low-hanging fruit in terms of if you're looking for areas that are going to hold up better this year and present more growth opportunities. I believe household appliance production is certainly one of those categories. So when you think about all of the sectors that I've discussed so far, the question that I want you to be thinking about is, how do I pivot, right? Your job as the decision maker is to deploy the business's resources in the most efficient way. So you ask yourself, what segment of my product line, what vertical market do I tell my sales team to really put a big emphasis on? Which ones are likely to present less opportunities? And so we want to pivot away from those sectors. Your marketing activities, your promotional items, all of these should be thinking about pivoting to the segments that represent that low-hanging fruit and are going to be the easiest to achieve from an opportunistic perspective. One of those segments that I think is a little bit tough for people to decipher is the defense industry, but I want you to understand that despite its volatility, you can see the gray line here, the monthly just moves up and down very sharply. This has been a growth sector for the past 4 years, and it's one of the few key vertical markets that has not gone into recession during the pandemic. The reason is that it does not have a correlation to the economy. It's much more driven by defense sector appropriations, congressional budgeting, and we think that despite the volatility, this remains a very good area of opportunity as we look out over the next several years. In particular, we like the export-oriented sector of defense rather than domestic consumption. With some of the changes in the administration, we're likely to see a little bit less investment in the defense area domestically, but certainly companies that are making export of military and defense equipment are going to be in high demand and represent some really great areas of opportunity for you. For the computers and electronics space, another area of terrific growth already. You can see up nearly 5% year over year. 12% is the latest growth number on a month-over-month basis. We think that the work from home trends, they don't go back to pre-pandemic levels of activity. So it's going to be benefiting the electronic sector throughout this year and likely into next year as well. So another great low-hanging fruit sector and where you should be looking to invest. The last several sectors I want to talk about have to do with construction, and I want you to understand that the different aspects of the construction industry behave very differently related to where they stand compared to the overall business cycle. So housing, particularly single family and to a lesser extent multifamily housing, typically leads the economy by about a year. Non-residential construction, on the other hand, is actually a laggard. So it lags the US Industrial Production Index by about 12 months. So when we look at what's happening in housing, we are blown away by how optimistic the outlook is here. Housing starts, single family housing starts, are up 12.3% already, and the 312 is up nearly 25%. That's terrific. That's phenomenal. That means that over the next 6 months, you're likely to see more upside momentum. We're calling for about 20% growth in housing this year. That's terrific opportunities. If you look at some of the leading indicators to support that expectation, well, mortgage rates inverted, by the way. This is, you can see the low values here at the top, the higher values at the top. So the lower the mortgage rates go, the more prospects for upside momentum in housing. That's exactly what we're calling for. All the way through late 21 into early 22, we're going to have that ongoing rise. And you can see we're talking about significant growth opportunities in the housing market. So if this is an area where you're already operating, expect more demand side pull. If you're not, then can certainly consider entering that market space if at all possible. It's going to be a very rosy outlook, very good growth ahead for the housing market, not just this year, but for several more years to come. This is just another leading indicator. This is existing home inventory, also inverted. So the lower the inventory level goes, the more upward prospects there are to housing. That's exactly what we're expecting here. So the key is single family housing is the place to be from a construction perspective. Because if you look at multifamily housing, very different story. You can see year over year, it's down almost 12%. The 312 is below the 1212. That means further downside pressure is going to be evident on that year over year number. And it's coming off of an overbuilt, oversaturated sector. So our expectations are actually quite pessimistic for multifamily starts this year. And one of the drivers of that has to deal with pricing. So the price index of apartments, this orange line, typically leads multifamily housing by about a year. And you can see it's talking about ongoing decline into late 2021 before another rising trend starts next year. So understand, housing might be talked about in one sentence, but single family has very different prospects than multifamily. And then the kind of redheaded stepchild for this year, I think, is going to be non-residential construction. As I mentioned, non-residential construction is the laggard relative to the economic cycle. So what happened in industrial production over the course of 2020 is likely to manifest itself for non-residential construction this year. We've got a double-digit negative outlook for non-res overall, and that's fairly across the board. Office, educational, medical, certainly manufacturing, construction. That doesn't mean that there's not going to be any opportunities in this sector. It's just going to mean that you're going to have to fight harder for those opportunities. Keep in mind, this is an $800 billion market. So even a 10% contraction means over $700 billion worth of opportunities still out there. You're just going to have to be more aggressive in pursuing that. The leading indicators certainly confirm our negative outlook for 2021. This is the U.S. private non-residential construction to the ITR leading indicator, which leads by 18 months. So I've actually taken the data for that leading indicator and offset it by that leading relationship, which is why you see this green line stick out farther than the blue line does. It's the predictive ability of this leading indicator. And what I can see here is that certainly talks to downside pressure all the way through the end of the 2021 calendar year, which is represented by this period of time here. There are other indicators that actually say that negativity might last longer than just over 2021. So this is the US Architecture Billings Index. This is also offset by its lead time. So push forward by the 18 months, you can see how clear the correlation is through the various business cycle highs and lows. And this is actually talking about potential for negativity well into 2022 before the non-residential sector has a prospect of turning around and heading into a more positive, more favorable direction. The last leading indicator here that talks about that negativity is corporate profits. So pink line here is non-residential construction. You can see it's down 4.5% year over year. The corporate profitability, which is what drives investment in buildings, non-residential buildings most of the time, is pointing to a mid-2022 low point. So I just want to make sure that you temper your expectations regarding non-residential construction. Again, not to say that there won't be any opportunities there. It's just that they're going to be a lot harder to achieve than what we saw back in 2019, and certainly with the backlog carrying over into 2020. So temper your expectations related to non-residential construction. All right, I hope that you found benefit in that vertical market analysis. At the end of the day, though, I want you to understand that to be a data-driven decision maker, you have to look at your own data. And if you've talked about this with ITR economics before, if you've heard some of our presentations, you know that there is a way to look at your own performance and derive the same kind of key insights that I've been sharing with you throughout this presentation. But what you need is access to your own data. So to walk you through this process, I want to highlight for you that all you need essentially are the monthly sales for your business going back at least 5 to 7 years. But in this particular case, I'm showing you the monthly data for the last 2 years. So when you look at your own performance at this level of regularity, at this level of frequency, it's hard to identify the trends that exist in the numbers. So to assist with that, what we do is we calculate the rates of change. To do that, you simply compare the last month of your top line sales revenue to the same month from a year ago, and the first rate of change that you can calculate is the 112. That is the rolling month-over-month growth rate plotted over time. What you'll see here is that the low point in the cycle on a 112 basis was clearly back in May, and that you have been consistently improving over time since that point, with December's value actually reflecting the first time that you're year-over-year positive since before the pandemic began. So that's the first confirmable sign that you can clearly see my business has this upward trajectory. We also want to do this on a quarterly and annual basis. To do it quarterly, you need to calculate something known as the 3MMT, or the 3-month moving total. And that's simply adding the last 3 months of data together. You then compare that value for December's 3MMT to the same value for December 2019 3MMT, and you calculate what is known as the 312 rate of change. That's, again, rolling quarter-over-quarter growth rate over time. Similar messaging here, a low point in that cycle back in June, so end of Q2, rising rates of change, and a positive growth number overall here through the fourth quarter. The first time your quarterly number has been positive since March. The last step here is the 12-month moving total, or the 12 MMT, simply the addition of the last 12 months of data plotted together, then compare that to the same period from a year ago, you get something called the 12/12 rate of change. So here's why this is important. I know that many of you just went through this process of looking at your overall performance in 2020. You calculated the growth number relative to 2019, and you made a bunch of really key decisions based on that performance. But what you need to understand is you can't do that once a year. You have to do it consistently and regularly, and you have to then reflect changes in your own strategy and your behavior based on what you observe here in these rates of change. So looking at this latest 12/12, you can see it bottomed out back in September, October, and has now transitioned to a period of rise. This shows you that you've gone from a period of phase D, which is recession, to phase A, which is recovery. And that means that your actions and decisions have to change to reflect that development. You cannot do the same thing that you were doing back in recessionary times as you are when you are in recovery mode. So I know that that's not the best way for some people to learn a bunch of numbers plotted on a slide. Here's what this looks like visually, okay? It's the same company data, a $5.7 million business plotted over time. Here's the 112, that's the month-over-month rate of change, the 12/12 being the green line, the year-over-year growth rate. So look at the key elements of observability here. The low point in the 112, that's the checking point number 1. The second checking point is when the 112 upward passes the 12/12, and the third checking point is the 12/12 low, which now we know happened 2 months ago. So this business is at a precipice of a totally different phase of their own business cycle, and they need to be doing things differently to reflect that. If they don't, if they continue to operate the same way that they were when their rates of change were declining, they're going to be behind the curve, and that will allow their competitors that are using this methodology to get out ahead of them and to be better prepared for that rise before this particular company does. So I implore you, it doesn't cost anything for you to do this. You have the numbers at your disposal. We have actually put together a great free toolkit for you to be able to implement this assessment in your own business. If you go to www.itreconomics.com/methodology, there are videos and white papers and podcast episodes and all sorts of tools for free that you can leverage to develop this type of analysis for your business. But the key here is ownership and taking responsibility of it, so that any point in time, if I'm your economist, I should be able to say, what phase of your business cycle are you in and what are you doing about it? You should have a very readily available answer for me based on this type of analysis. If you're not already doing it, you're simply leaving insights on the table. So if you are correlating to the general industrial economy, if you are in this type of position when you've now transitioned into the early parts of phase A, what does that mean? What can you do about that? I told you at the beginning, I wanted to provide you with key, actionable, and practical takeaways, and that's exactly what I'm going to wrap up with. So as you get into this phase A, which much of the fastener distribution industry is currently in right now, you need to ask yourself 3 key questions. Number 1, do I have the cash to climb the hill? You need to be able to put money to work, whether it's from your own cash trove or leveraging other people's money. You've got to make sure you have the investment dollars available, because that's what it's going to take to get ahead of your competition. Number 2, where are the bottlenecks? Think about 18 and 19 and what are the challenges that you face? Where were the limitations in your business? Address those bottlenecks right now in anticipation of that growth over the next 3 years. And finally, what do you wish you had done differently back in 2010? When you were just coming out of that Great Recession, if you look back and ask yourself, what could have resulted in a better overall business performance over the next decade? That's the kind of thinking I want you to bring to the table right now. So we provide answers to some of these questions. Phase A of your business cycle corresponds to specific action items. And I've given you an example of 10 of them right here. I want to call your attention to the last 3 in particular. Allocate additional resources to sales and marketing. That's going to be the difference maker between just trending with the marketplace or actually outperforming and gaining share. Invest in system and process efficiencies. Automate, automate, automate whenever possible. You're not going to regret it as you kind of push up against your capacity constraints, both in late 21 and in 22. And then finally, ask yourself, is there an opportunistic capital or business acquisition? Can I use other people's pessimism to my own advantage to position the business to take full opportunity of the growth that is coming ahead? So I hope you found all of this useful. I know that it's a lot of information. I tried to break it down to you as much as possible, but if I were to put this into the simplest terms that I can, the road ahead looks like this. This year is very much a recovery and business cycle rise year. We have a peak in our expectations for the cycle in early 2022, and then we have a transition to what we call the backside of the cycle, but that doesn't mean recession, it just means slowing growth over time. And then when we look towards 2023, it's ongoing expansion, but at a slower pace than what you're going to experience in 2021. So look forward with optimism, make sure that you're planning ahead, getting out in front of your competition, and that's going to allow you to have a great several years to come. So the last thing that I'll do before I'll open it up for some Q&A is just to advise you to stay informed. You know, there's so much noise coming at you all the time. You have to be able to separate the wheat from the chaff, if you will. So we think that ITR Economics is that reliable, trusted partner that you can leverage to do exactly that. So follow us on various social media platforms, Facebook, Twitter, LinkedIn. My personal Twitter profile is right here at Chausovsky. We're constantly putting out free content, blog posts, podcast episodes, little write-ups or our thoughts on the latest political developments. It's all designed to help you do exactly what you need to do, which is be that data-driven decision maker. So I hope you found some value in our time together. I certainly want to say thank you again for your time and for keeping up with the torrent of information that I've thrown at you over the last hour or so. And at this point, John, I'll turn it back over to you and be happy to answer any questions that you might have.
Excellent. Thank you very much, Alex. And for those of you who may have joined us, prior to the beginning, if you have any questions for Alex, you'll see the chat button at the bottom of your screen. For me, it's in the bottom right. So if you have any questions for Alex, please utilize that button. We'll compile the questions and I will ask them on your behalf. But if I could just start with a question, Alex, myself, when you look at, the 2021 forecast that you've provided, what are the biggest upside and downside risks that you see to that forecast?
Yeah, that's exactly the way that I want you guys to think about this. What are the risk factors, right? So I would say in terms of downside risks, obviously the variants that are out there for the pandemic are concerning. We don't know exactly what impact that's going to have. Certainly think that it could limit the upward pace of expansion this year. I would say that the other big challenges, in my opinion, number one, the supply chain risks, especially if you have exposure to automotive. But in general, I think you need to be looking at your suppliers and constantly asserting whether or not a diversified supplier strategy is something that you should be pursuing beyond what you already have in place, because we've clearly seen many companies hurt by that. So I think that's a risk factor, is disruption in supply chain. And then this profitability concept that I talked about, the increasing prices for those companies that cannot get out ahead of it, don't have the right hedges in place, don't have the right pass-through contracts in place, that could be a real big pain on the bottom line. So all three of those, COVID variants, supply chain risk, and the pricing disruption and the profitability squeeze, I would say, are all downside risks. Now, flipping the table a little bit, upside risk, I would say, we're very encouraged by the pace of vaccinations. They continue to build. So we could be out of this pandemic sooner rather than later. That would certainly bode well. I think if you look at the political landscape, the potential for an infrastructure stimulus package is very high, especially with the latest weather in Dallas kind of highlighting the need to invest in our nation's crumbling infrastructure. That's going to be a potential upside risk factor. And then I think that when you look at general dynamics in terms of demand coming back, we've seen resiliency surpass people's expectations. I think that's certainly going to be another upside risk factor. And then third stimulus package looks like very likely 1.9 trillion is on the table. As I've shown you already, that's already buffered the economy to quite some extent with versions 1 and 2. A third one would only extend that upward momentum onwards into 2021. So all three of those things, I would say, are going to be upside risk factors to our outlook.
Excellent. Thanks, Alex. Just to harken back to a previous slide you had shown about, the risk to the supply chain by countries. Where do you think India falls on that risk chart? Someone wants to know. And also, do you think the UK will remain strong? I think it was the strongest, even as they go through Brexit. Any
so I think that it's a very astute observation. I do want to point out that the countries that I showed on that chart are not the full spectrum of countries. Actually, the strongest, most resilient supply chains are in the Nordic countries, Sweden, Finland. They have great access to ports and infrastructure. They're very stable countries. So I would say that even above that of the UK, you've got some of those Nordic European countries. As far as India, I think that the biggest problem that India has, and it has been historically the big limiting factor in terms of India really developing into the promise that it has held for all of these years, is the infrastructure. We know that they still have rolling blackouts in their electrical grid on an ongoing basis, even in some of the major cities. Now, they are making progress, but I would say India is about 20 years behind from an infrastructure development relative to where China is today. So I would probably grade them somewhere between Mexico and Vietnam, and then China in terms of their supply chain resiliency. So because of the infrastructure problems that they have.
Excellent. Melissa Patel, hi, it's good to see you. Actually, I don't see you, but hello. She wants to know, what's your prediction for the value of the dollar, specifically as it relates to the NTD, New Taiwanese dollars, and the RMB?
It's tricky to talk about it relative to the RMB because obviously I can't predict exactly what the government in Beijing is going to do. The RMB value is so heavily influenced by the government in Beijing that I will say the focus of my response will likely be on the Taiwanese dollar. And I'll just make this comment in broader terms. We see a gradual depreciation of the US dollar relative to a basket of foreign currencies, the Taiwanese dollar included, over the course of 2021, driven in large part by the massive amount of stimulus money that we've injected into the system. So if you look at it versus the yen, versus the UK pound, the Canadian dollar, certainly the euro, we are seeing depreciation, but to a relatively small scale. It's not going to be severely disruptive. I would say that the commodity price changes are going to be a much bigger influencing factor from than the exchange rate dynamics that are going on.
Excellent. Again, I encourage you all to use the chat function at the bottom of your screen if you have any questions. Every time I've attended one of these in the past, the questions, we tend to have to run out of time, and now is a good time to ask a question if you have one. Another question, what are the measurables that you look for as far as supply chain costing goes, and how do you factor in risk to that supply chain? The comment is so many companies don't look at the total cost to quantify. Any thoughts on
Yeah,
that?
I mean, I think that in particular, when I observe the challenges that my own clients encountered over the course of 2020, the most difficult ones to overcome have been related to staffing and the availability of labor, not only within their own operation, but more acutely within their supplier. So what I mean by this is, if you have a fairly substantial sized company and they source from multiple smaller supplier players, those guys were much quicker to cut to the bone in terms of when the pandemic first happened, they cut staffing levels. And so now that the demand has come back more robustly than most people were expecting, those suppliers are having a very, very difficult time meeting their production obligations because they simply don't have the people in place to produce the content. So I would say that to me is one of the greatest challenges because, as I mentioned earlier, labor, both retention and attraction of labor within the manufacturing and the distribution overall supply chains is going to remain a big challenge over the course of 2021 and beyond. So I would say that that's primary. Now, the component, the material shortages, I think are shorter in terms of their implication and disruption. There's typically levers that can be pulled there, but I would say people over the actual materials and components.
Excellent. And just for the record, I did misspoke. I know you guys don't have chat. Use the Q&A functionality. So I'm sorry, I'm learning the technology. So my fault. A very interesting question. Do you think businesses should follow Tesla's lead and plan on accepting Bitcoin or cryptocurrency as payment?
Well, now we know it's been a successful webinar. When I get the Bitcoin question, I know I've done my job. So I think that clearly there are signs that Bitcoin is becoming much more mainstream. There are companies outside of Tesla. You're talking about payment processors and other credit card companies that are moving to have at least part of their assets within Bitcoin and accepting Bitcoin as payment. I think when I talk about the long-term viability of Bitcoin, what I come back to is that governments are not going to want to be left out of this new reality of payment systems. And so that the Chinese have already taken concrete steps to launch their own cryptocurrency. I know that the Europeans and here in the US, our governments are looking seriously at that as well. So as far as Bitcoin, I'm not a huge fan of it as a speculative investment, but clearly there are signs, Tesla being a good example, but many other companies as well, that it is gaining more mainstream adoption. And it's essentially something that builds upon itself. As more and more heavy-hitting institutional investors pile into this currency, there's likely going to be some additional upside in terms of pricing from these levels. My biggest concern with Bitcoin, and we've seen this unfold time and time again, is the attractiveness from a crime and a theft perspective. We've seen the exchanges, including some of the more prominent ones, be robbed of millions of dollars of Bitcoin in a single transaction. And I just don't like the concept of not being able to easily trade in that currency. There's still very significant obstacles to being able to make liquidity happen very quickly in that space. So I think that while there are moves to make it more mainstream, I'm still personally a bit of a skeptic, and I'm okay to sit out and just watch the appreciation in price because I don't fully understand the risks involved relating to Bitcoin as a long-term transactionary tool.
And the fact that there's a currency called Doggy Coin is always puzzling to me, but that's
it's Dogecoin, John.
Dogecoin.
Dogecoin.
Oh, I'm sorry.
Yes, and there are thousands of cryptocurrencies. Obviously, Bitcoin is clearly the best known one, but some of the other top ones, Ethereum, Ripple. When you look at the usability case studies, Ripple, for example, is the preferred choice for financial transactions because the settlement of the rectification of the ledgers happens within seconds. Bitcoin is still, you're talking about a 10-minute transaction. So when it comes to the financial system, you can't execute trades nearly as quickly. So the usability of Bitcoin relative to some of these other lesser known cryptocurrencies, I think, is another detractor in my view. Don't let me discourage you from investing, though, if you want to gamble.
I didn't butcher your name, but I butchered Dogecoin, but I stand corrected.
That's okay.
Scott Longfellow wants to know, do you have any recommendation where public economic data could be obtained to roll into our own data models, preferably data that we could link to with business intelligence software?
Yes, I have great recommendations. It's obviously an area that ITR economics really specializes in. We've built some fantastic tools that allow you to take your own data and plot it and chart it versus many of the leading indicators. We have over 10,000 in our database. But as far as your question, to answer it more directly, there's plenty of publicly available government source data. You look at places like US Census Bureau, that they provide a lot of new orders data, and especially in the industrial domain. You look at Federal Reserve Board, they provide a lot of production level data. There is, there's other sources that I can mention, but I think relative to the cost benefit analysis of having to search out all of those sources of data and then trying to tie them into your own business intelligence, come talk to us. ITR Economics has already done the legwork on that. And for a relatively small annual subscription cost, you have a great set of tools that you can do exactly what you're talking about with us having done all the legwork for you.
Warren Brooks, how does the electrification of the auto industry factor into some of your future growth predictions?
Yeah, I'm glad you asked this question. So we've done a lot of analysis on the subject. Right now, we're only talking about 1 to 2% of the total automotive production market being in that electrified space. We clearly have heard the news in California going to all electric by 2035. One of the things that I keep coming back to in terms of how disruptive is this going to be for me in the near term, the 3 to 5 years, the conclusion I always come to is not very, because when you think about even as you get out into the mid 2030s and 2040s, when the newer cars are going to be fully electric, the existing install base, which is hundreds of millions of vehicles strong just here in the United States, is still going to be primarily combustion engine driven. So you've got a very long-term transition happening. Certainly important to keep abreast of the situation and to look for opportunities to capitalize on it. And for example, electrification infrastructure is an area that's getting very significant momentum in terms of building out the network of charging stations in the country to support the future electric vehicles. But at least in the near term, from a production perspective, we're still going to be years, if not decades, away from electric vehicles being the dominant focus for the automotive sector.
I see Volvo came out today and say they're going to be all electric by 2030. So we'll see how.
So again, to the same point that I mentioned with California, yes, their new car sales will be all electric, but the vast majority of Volvo's install base of vehicles are still going to be combustion engine driven, probably through 2050, right? So we've got a long way to go before we really start to see the new face of the automotive world as it pertains to where we stand today.
How do you see technology impacting manufacturing? Someone's looking to know.
That's a tough question to answer because there's so many ways and almost an infinite number of ways. But I think that overall, I'll answer it this way. I think it's going to have a very positive impact on manufacturing. I think we've seen the fears, as with any technological developments in the early 90s with computing, in the early 2010s, it was 3D printing. These are technologies that are meant to accelerate and improve productivity and output in the manufacturing domain. The fear is that they're going to eliminate jobs, but we now have concrete evidence that manufacturing technology improvements clearly create more jobs than they eliminate. And so whether it is 3D printing or AI or IoT technologies or anything dealing with data analysis and improvements from that perspective, I think we're at the very tip of the iceberg in terms of where manufacturing is today relative to where it could be in the years to come. And it's one of the main reasons why we're so bullish on manufacturing in the United States over the next decade, is because we still think that there's a great deal of opportunity to improve efficiency and productivity through some of these technological advances. One key example that I can give you is in the area of IoT. So it's basically using sensors and various predictive maintenance techniques to be able to ensure uptime in manufacturing. Historically, businesses, particularly small and mid-scale manufacturing companies, have been very hesitant to adopt IoT because it involves sending their proprietary manufacturing data into the cloud. But in December of last year, Amazon actually developed a solution. And when when Amazon comes into the market, they believe that there's a big opportunity for something. They've essentially established a cloud on-site solution. So they provide you with the rack servers and the technology to do all of the analytics without having to send the data into the cloud. And it's going to really be a significant movement over the next several years towards that end in terms of both predictive maintenance and ensuring of uptime and squeezing out those productivity gains that we were talking about. So I'm very optimistic and very encouraged by what I see in the technological advances in manufacturing.
Excellent. Alex, another question related to vehicles, battery versus fuel cell. Which do you see as being the dominant in the automotive heavy truck industry over the next 5 years?
I'll admit, honestly, in terms of the knowledge that I have in terms of fuel cell technology, I am fairly limited. What I know is that, the Tesla Semi is expected to be a fairly big thing in terms of heavy duty, large truck market. That's obviously battery technology rather than fuel cell. I think fuel cell technology is getting less attention, less investment dollars overall right now than when you look at battery tech. I think based on that assumption alone, I would say that it's likely going to lean towards the battery side of things rather than fuel cell side of things. But again, I'm fairly limited. I don't know enough to really adequately answer that question. But just my gut feel based on all of the observations that I've seen from the development of the off-duty truck and the heavy truck industries is that it's battery related. I will make one recommendation. We actually have a partner company called Interact Analysis. They specialize in research into the electric vehicle, particularly in the bigger vehicle markets. So not light vehicles or light trucks, but rather heavy trucks, buses, vans, off-road type of vehicles. They produce market studies on this subject, and they have some experts in-house that would be much better suited to answer your question. So please reach out. I'll put you in contact with Alistair Hayfield, who's their director of oversight in that area, and he'll be able to have a much more robust conversation with you on the subject.
Excellent. Alex, I know you do a lot of these per year, right? Is there a specific question you get a lot of that we haven't asked or that no one has asked? Is there a common question that you normally get that you haven't been asked today?
No, we've gone through a big range of questions. I've really been impressed with how engaged the audience has been. I think that if I were to say one area that we haven't really covered in great length is kind of that the details of the long-term outlook and what you should be thinking about, not just over the next 3 to 5 years, but as you position your business for that difficult period in our nation's futures for the 2030s. What are some of the specific strategies, both from an investment perspective and from a hedging, from a downside protection risk perspective, would you implement? So I certainly would think that that's something that you should be looking forward to and thinking about, despite the fact that right now you're dealing with, obviously, your main focus is on the near term, basically getting back to quote unquote normal, but don't lose sight of the medium to long game and make sure that you're positioning not only your business, but also your personal finances to withstand those challenges of the 2030s that we've been talking about for quite some time.
Okay. Are there any more questions out there? Again, if you have any questions, now your time. We've budgeted another, 10 to 15 minutes, for questions. If you have any questions, now is the time. I would urge you to use the Q&A functionality at the bottom of your screen. While those are pouring in, Alex, I just want to thank you for, great information and a great presentation. I know, the ITR presentation is always a highlight for me. When I come to NFDA events, I also want to, just get a quick plug in for our next session, plating and coating your fasteners for performance and cost with Lawrence Klaus. So that should be a good one. Hopefully we'll see you all there. I don't see any more questions out there. Alex, thank you again. This has been great. And thank you everyone for, for attending. And I look forward to seeing all of you live at the next NFDA event, hopefully live at the next NFDA event, whenever that may be. Be well, and thanks everybody for your time, and thanks again, Alex.
Thanks, John. Appreciate it. Take care, everyone. Have a good one.
Have a great day.